All right, we're back at it, and here we are dissecting how to design an IBC policy. You probably have seen the main video, and maybe you've even seen us dissect the Nelson-Nash model. So we're gonna move on. We're gonna talk about
the beast.
Yeah, the beast. Why do we call it the beast? Well, because it's a beast. It works incredibly well. I would say that this policy design is probably one of the most efficient policy designs that we use. And the reason it's efficient is it doesn't sacrifice all the base. Because remember I said in the first one, it's all about the base. Okay, this keeps 25% going to the base. That's a lot less than the Nelson-Nash model where that was 40% going to the base. Now we're cutting the base down to 25% and we're putting 75% to the paid up additions rider, which now means you're gonna have more early cash value that you can take out immediately. But what's the sacrifice for the beast? And as we go through all the rest of them, as we cut back on base and add to PUA, here's what you're typically gonna see. We're gonna start having to introduce a term rider into the plan designs. So the Nelson-Nash model, the reason it's the most efficient one is because we typically do not have to add term to it. But if you do a dump into the Nelson-Nash, we gotta add term. If you dump money into any of the designs, we're gonna add term. But the beast, we've designed this so that we don't have to use a lot of term insurance. If we don't do a dump in, we actually have been successful in designing the beast, 75% PUA, 25% base, without any term. But I'm just telling you, for most of you, when you're looking at designing a policy, if we do the beast, then you're probably gonna have a term rider. Now, what's the downside to the term rider? Well, the downside is you've got a term policy inside your whole life, essentially, which means that term policy adds another cost. Now, here's what we do. I don't think this is a huge problem. I mean, if you're a little bit older in age, the term gets more expensive, but it's necessary because of the MEC 7 pay rule, which is the IRS rules. Not gonna get too deep into that because we'll cover it in a little bit, but I want you to understand that as we add term riders, it cuts back on the efficiency of the growth. There's nothing we can do about it. We can't just eliminate the term because the government, the IRS, says that we have to have it because of that MEC rule. So why would we want to add term? Well, we want to add term so that we can get more into the paid up additions rider. So we can put less death benefit on from the base, and then we can put more money into the cash value. The sacrifice is we can't get rid of death benefit, but we can use cheap alternatives like a 7-year or 10-year term rider. So you heard me say that, right? Term is a life insurance that's set up for a term of time. So we use a 7-year and a 10-year term rider. Do you know why? Well, the reason is remember the MEC 7 pay rule. 7 pay means for 7 years, 7 premium payments. So what are we trying to do? We're trying to meet the MEC 7 pay. So for 7 years, we need to have a certain amount of death benefit on the policy, but with this policy, with this beast, we just took away a bunch of the base, which is the whole life death benefit, so we need to make up that death benefit to satisfy the MEC 7 pay. So we just add a term rider. But we get rid of that term rider in 7 years, or in some cases 10 years, depending on the plan design. We get rid of it because it's just not efficient. But if you paid attention to the Nelson-Nash example that I did, you will understand that the base is really efficient in later years. But we've only got 25% going to the base now. So the trade-off here, if you're gonna use the beast or any policy design that we talk about from here on, like the Slayer or the 90-10, it's very important that you have somewhere for that money, the extra cash value that we create in the early years. We have somewhere for that money to go and earn a higher interest rate because that's what's necessary. Because you got an extra cost in there, folks. That's the term rider. So let me dive in and start to really show you how the beast works. But before we do that, I have a favor. It's almost Christmas time, and you know, I like to get my presents a bit early. So what I'd love for you to do right now is just click that little button. See, it's somewhere on the bottom there, right here, and it says subscribe. Please click that. And then right up above, oh, damn, Santa, he's pissed at me this year. Up top, catch my breath, is a little bell. I want you to smash that bell, and then back to the regular scheduled show. Thank you for clicking that. Let's dive into the beast and show you how it is. In full transparency, some of the things I'm going to show you are proprietary to the money school and the money multiplier. They can't be designed by any other agent or agency. Why? Well, because we've gotten to a certain point where we have the ability to design plans that nobody else can with these carriers. This is not one that's unique to us, but this is one that not a lot of other people are doing. This one takes, out of the $10,000, we're gonna put 75% of your money to the paid up additions rider. And we're gonna take and put 25% to the base. You see how all we're doing is we're shifting and putting more to the paid up additions than we did before and less to the base, reducing the main rocket, increasing the booster rocket, because we need more thrust early on and we're not as concerned about later efficiencies. In this design, we're putting 75% of your premium deposit. Let me just hit that real quick. You keep hearing me say that. When you think of a whole life insurance policy, you think of a premium being an expense. I don't want a premium, I don't want an extra expense, don't you? But when you think of your deposit that you make into your bank, you walk into your bank and you're like,
oh man, I'm so excited, I got myself a deposit. Hey, Mr. Bank Teller, I want to make a deposit today.
And you slide that money over and the bank teller looks at you, says,
how are you doing? Would you like a sucker?
And you know what, you're thinking you're in a good mood, you're making a deposit, you're thinking,
yeah man, I definitely want a sucker. What do we got?
You look up in that little cup and you got yourself
some strawberry, some grape, you got some lime. Oh, we got a okay, I'll take the raspberry.
And you grab the sucker and without even paying attention to the wrapper, you unwrap it and you start enjoying the sucker. But as you're waiting for the teller to make your deposit, you look at the sucker that you just started enjoying and you look at the wrapper and it says, Dum Dums. Now you may or may not really think about that. But there's a hidden message in there. There's not a bank that I've ever been to in this country that doesn't have one type of sucker, and that is Dum Dum suckers. That's right. You now, by making deposits in their bank, have given them the ability to make your money go to work for them. They just take your deposit, they do not put it in the vault with your little name taped onto it. They take your deposit and they make that money go to work for the bank. They lend it out, and they lend it out at a much higher interest rate than what they're paying you on that. In other words, you worked hard for your money. You then gave up control to the bank. The bank now is in control of your money, and the bank makes your money go to work for them. And all you get is you get a measly little interest rate that will vary and fluctuate and change just like it has every other time in history since banks came into existence. But you enjoyed making that deposit, which is what that story was. So when you're making a deposit into your specially designed and engineered whole life with the effort of you creating your own banking system. So what we're actually doing is we're creating what the wealthy call private banking. We're creating your own private bank. That's right, because that's exactly what we're doing here. By creating this policy to then be used with the infinite banking concept to take back control of all your money, make your money work for you, you are indeed changing who the bank is. You are performing what we call BYOB, be your own bank. So when you make a deposit into your bank, which just so happens to be a specially designed whole life, we can't call it a premium because a premium in your mind, you think of an expense. So we call it a premium deposit. Sorry I went so long with that, but it's important that we realize in learning how to be your own bank, you change the way you think about money and you change the way you think about everything you've done with money up to this point. 75% goes to PUA. So we're gonna put 7,500 there. 25% goes to the base. So now we've changed the dynamic of it. But in doing this, unfortunately now, because of the MEC 7 pay rule, we have to add term insurance. So we're gonna add a 10-year term rider. Why? Because I don't want it after the 10th year. Because remember that rocket with the drag? I don't want drag. So what's the soonest I can get rid of it? The 8th year. But I'm gonna keep it on for 10 years and I'll explain why. But this 10-year term rider, we're gonna have to add this rider, and this rider is gonna be for $100,000 of death benefit. And that $100,000 of death benefit is gonna have a cost for me, because this is my policy design, of about $196. So this is the drag. Now, this design is pretty efficient because it doesn't require a ton of term, which is why we like it. We get more early cash value without having a whole bunch of expense. Another design we're gonna talk about in a little bit is gonna have a lot more term because we need it to support the IRS rules, which means this policy in year one is gonna have a death benefit of $160,843. So the only difference between the 60-40 and the 70-25 is we now have had to introduce a term rider. So let's go into the numbers, but let's go quick. Remember, we're still putting 10,000 in, but once we put the 10,000 in the first year, we have 76.91 to use. If we want to take a loan immediately in the first 30 days when your check clears, we're going to have slightly less than the 76.91, but close. It's just going to be that minus the interest and the dividends for that year because it's immediately. But in the fifth year, we put in $10,000 and we can take out $10,573. See how that's a little bit better? We're actually growing more. Why? Well, because we have more money compounding. We've lost less to the cost of insurance, therefore we have better growth in the early years. In the 10th year, we put in 10 grand and we can take out 13,477, slightly better than the 60-40. But then after the 10th year, something happens. After the 10th year, now we can only put $2,500 into the policy. Now, why is that a bad thing? Well, let me ask you something. If you had the ability to put $4,000 into the policy, okay, here, in that first policy design, 60-40, and this will be the last time I go over this, but in the 60-40, we were able to put $4,000 in the 11th year. And if we put $4,000 in, we were able to take $4,600 out. And as we got to the 15th year, we put $4,000 in and we were able to get $9,500 out. Now in this policy design, after the 10th year, we can only put $2,500 in. Now, if I'm a logical thinker, at the point when I'm at the 10th year, and this policy is the most efficient, because remember, that's when the rocket's the most efficient, anytime after the 5th or 7th year, depending on the design, that's when every dollar I put in, I'm taking more out than what I put in. So wouldn't I want the ability to put more money in if I can take more money out? I'd want the maximum amount to be put in. I'd want to put the most that the IRS allows me to put in if I always know that for the rest of my life I take out more than what I put in. But you see, by doing this design, which gets me early cash value, I give up long-term ability to make more money. Because now, in these later years in this design, the 11th year, I only can put $2,500 in, which means the $2,500 allows me to take $4,000 out. In the 15th year, I put $2,500 in, and I can only take out $81.25. In the 20th year, I put $2,500 in, and I can only take $9,800 out. Do you see what I'm saying? This policy is more efficient for the long term because I have the ability to put more money in at the most efficient time. As we keep going, we're gonna be able to take out less and less in the later years because we can put less and less in, but we gained a little in the early years. So depending on your needs and your goals, that's what determines how we design your policy. Now, over here, let's just talk about the commission, because now in this policy design, the commission is going to be slightly less than it was in the 60-40. So if I take the base, now I'm only getting paid the 55% on $2,500 and roughly about 2%, give or take, depending on the company, on the $7,500. So my commission on this one would be roughly $16.28. Okay, that's about how much my commission is, which is a little bit less than the 60-40. So because it's a little less, that's why you have more in the early years. So that's how the 75-25 works. We call it the beast, and we love this design for people who want higher early cash value early on, but they still want to maintain some efficiencies in the later years. So that's the beast, folks. It's an awesome design. It really is probably one of our most used designs out of all of them, especially if we're layering in a dump in and we want maximum cash value. So please take this and understand that there are also other designs. You should research all of them and then have that information ready so that when you book a call with us, you already know what your needs and goals are and what problem you're trying to solve. So we know which design to apply. We're that good, yes. We've done this thousands of times. We know exactly which design will solve what problem, and that's why we created these models. You just saw the beast, and not only that, did you enjoy this? Did you like this video? Because if you did, you're gonna wanna check this video right here out. It's called How to Design an IBC Policy Updated. Hey, hold on. I think this is the appropriate time. It's almost Christmas, and I'd like to have Christmas early. So if you could help a brother out by clicking that subscribe button right there, click that thing. And also while you're at it, there's a little bell somewhere on there. You can, they love hitting me with that. Smash that bell, and then you'll be notified every time we put new content out. See you on the next one.